Thank you very, very much indeed. I think it's a marvelous privilege to be in front of so many friends and brains, if I may, and I thank the organizers for this opportunity. I have also to say that the Ricardo paper was a tour de force, because it seems to me that he covered absolutely everything, and commenting and discussing on such a paper is really very, very difficult. I have been, during 8 years, the chair of an institution which is, if I count well, 14 and a half years old, or even perhaps 15 if I count the creation, 6 months before it became operational. And of course, it humbles in front of 100 years old institution. And it reminds me the say that good decisions come from experience, and that experience comes from bad decision, which we had not much time to make so many bad decisions. But let me say that I am very impressed by the candid way that you are examining your past with an approach which is so candid. It's very, very impressive. I have 4 points commenting on Ricardo paper that I would like to make. One on the Fed role in active cooperation between central banks. The second on the nature of unconventional quantitative measures. The third on what I would call the conceptual convergence at a global level in which the Fed plays a decisive role. And the last point, short reflection on independence. Very rapidly on the first point, I have participated in all G7, G10 global economy meetings that we had in Basel between central banks or with the executive branches. And I have to say that not only the very and decisive way of the Fed to be an active participant, but the simplicity and the kindness, if I may, Ben, in front of you, of the representative of the Fed, Alan, Bill, Roger, yourself, Ben, when you take the helm, Don, Tim, Janet, Bill, and I should quote many, many others. I think it was decisive in creating an atmosphere of intense cooperation, intense and simple, easy communication, which appeared decisive in the crisis. That crisis, to me, was probably worse than what started in 29, because the unfolding of the crisis was so rapid, we could really see the house of cards collapsing under our eyes. The counterfactual is very difficult to make, of course, as always, which creates an enormous difficulty to defend what you've been doing. But I was the testimony of what has been done since the very beginning of the crisis, and it's very impressive. I will ever remember, Ben, when you pointed your finger on me at the beginning of 10, and you were telling me, Jean-Claude, now it's your turn. Meaning the epicenter of the crisis crossed the Atlantic. You have the epicenter of the crisis now, and you were pretty right. And still are, probably. The epicenter is still there. 1 minute on the reflection on the nature of the unconventional quantitative measure. First of all, we did not practice the same tools. And again, I have to say very, very clearly, financing of the United States of America economy, 80% market, 20% banks. Financing of the European economy, 80% banks, 20% market. So everybody should have that in mind when we compare both, I would say, the banks themselves and when we compare the action on market. Not surprisingly, the Fed concentrated on the unconventional measures very much on market. Not surprisingly, we concentrated very much on banks. And our way of being unconventional was from the very beginning. And for us, the very beginning was the 9th of August 2007, provided unlimited liquidity at fixed rate. The fixed rate at the time was 4%. And we went through the bank. So I say that because I think it's very important. We have a tendency to forget that and compare what we were doing without understanding that for us, banks were decisive. Now, let me only say one word. I would be more perhaps in the camp of Ricardo than in the camp of Alan for once, because generally I'm very close to you, Alan. But I would say that clearly I prefer personally to consider that the quantitative measures, whether ours or yours, are very much designed to counter abnormal functioning of markets, disruption of markets, abnormal functioning of counterparts all over the financial sphere, and are not necessarily pursuing policy when you are the zero lower bound by other means. And I see a lot of good reasons for that, to introduce some kind of separation principle. It seems to me that you have yourself this separation principle when you say the interest rates are one thing, and we have quantitative indicators for the, or target for the conventional measures. The unconventional measures are of a different nature. I don't insist on that, but if I have a message, it would be that perhaps even the two are mixed, I would say. The paradigm I have a preference for might be useful. Third point, conceptual convergence. I will not insist. We have seen a formidable evolution of the concept of inflation targeting, which has moved towards medium-term, medium-long-term, which, by the way, Ricardo, helps considerably to reconcile the level of price and inflation. We have differential price stability in the medium term ourselves, which was less than 2, close to 2. As a matter of fact, after 14 years, we were at 2.03%, which means that the level of prices was fully in line with that definition. I see, of course, an enormous convergence with the US when Ben said, for me, price stability is 2 or slightly less than 2. I see the Japanese joining. Enormous convergence in terms of differential price stability, enormous convergence in terms of banking supervision, enormous convergence also in terms of communication, even if there are still some differences. But I would say that we converged a lot, and I take that positively, of course, in the worst crisis ever since World War II, which could have been the worst crisis ever of the advanced economy since World War I, in my own understanding. Now, last point. There I know that I am in a very, very, I would say, complex conceptual universe. I am encouraged by Paul saying, I am not in favor of the dual mandate, full stop. So let me say that the dual mandate, and of course I agree with Nancy that it's very complex. The main problem I see, frankly speaking, is that if there is such thing as a short-term, medium-term, and long-term, no, perhaps not a long-term trade-off. Perhaps we all agree on the long-term trade-off. But if there is such thing like a pertinent trade-off, then is it thinkable that the political branches, legislative and executive, give that responsibility to make the arbitrage to a group of course, very wise persons, but nevertheless not mandated politically. So I have a problem there. Of course, the reality is the reality, and it remains complex to understand fully the Phillips curve. But I would say, theory, which is the theory that most central banks, frankly speaking, still have, namely that medium-term price stability is a condition which is necessary, but of course not sufficient to deliver growth and job creation in the medium run. I prefer that, because then you have the two goals, but one is more or less a necessary and not sufficient precondition for the other. And of course, I would have a real problem, Ricardo, with the 3 mandates, because then we are really asking the Open Market Committee or any monetary policy council to decide in the place of, all political institutions, and it seems to me that it's difficult to imagine. And of course, it might create explicit problem of independence. Now, let me only mention in conclusion, I have still 1 minute. And even I don't count the first exclamation point, the second one and the third one. But I know now what exquisite courtesy is practiced here. So let me only say that our own experience of central bankers is that you have, of course, the political institution, but you have more than that. You have your own country. You have the public opinion at large, the men and women in the street, the fellow citizens. And it seems to me that in any case, even fully independent, you have this accountability, which is not the accountability to the private sector or accountability to the market participants, but a very profound democratic accountability. And it seems to me that this is something I experienced myself, because as chair of the ECB, I had people that had not the same way of looking at things, not necessarily. So being the single central bank of various public opinion that had not yet fully converged was really a formidable experience, if I may, but I felt very profoundly that we were accountable to all of them. Already the 2 exclamation points. So I conclude. I conclude with things that I wanted, I would say, came to my mind when reading the paper of Ricardo. First of all, we had no exchange rate crisis during this abominable crisis, which goes on in a way, and I think it's very important. And I think we have to understand even better why we maintain order in the exchange rate since the very beginning of the unfolding of the crisis. Second remark, which is perhaps a little bit bold, when we were frightened by the overall conflict between Republicans and Democrats on the game which could conduct to a default, there was an impact on the signature of the United States Treasury. There was no impact at all on the signature of the Fed. And so I will not, contrary to Friedman rule, confuse the two personally. It seems to me that the Fed is, in the present situation, the ultimate anchor of credibility that exists in this country. That's my own understanding. I had a joke, but I keep it for myself. Thank you.